Private debt is an asset class garnering greater interest from investors, so could it be right for you? To share her views, Lucie Bielczykova from Revolution Asset Management joins us now. Lucie, great to see you there. Thank you so much for your time. Let's just discuss some of the dynamics, I suppose, driving interest in private debt right now. It certainly seems to have grown to greater prominence in the last few years. Why is that?
Yeah, you're absolutely right. It has definitely been a very popular asset class. There's been a strong interest from institutional investors, from super funds, insurance companies, not-for-profits and charities, all the way down to family offices and high net worth individuals. Mainly because it is what we call we say it's an all-weather asset class. And what I mean by that is that it's been able to deliver stable and uncorrelated source of income, regardless of the macro conditions that we've had. When rates were low, everyone was looking for some yield in their defensive allocations. And so that initially drove a lot of investors into the asset class in the low interest rate era. And once the economic environment turned and rates started rising, everyone sort of realized that they had a lot of duration in their portfolios and started to look for alternatives. And private debt has been a huge beneficiary of that because it is all floating rate. So there is no interest rate exposure. And so we don't have to worry about, what rates do next, whether they go up or down, because it does not affect the principal value of the investment. And on top of that, investors in private debt have actually benefited from rates going up because it increases the coupon that we earn on these loans. So typically what the structure of the private debt loans are that you earn a margin on top of a base rate. And so, as the base rate rises, the overall coupon that investors earn has risen as well. And so, for example, our portfolio or, defensive private debt in general is now earning north of 10% yield. And that's been particularly attractive in an environment where, most people would not expect that sort of return from, equities over the next 12 to 24 months. And at the same time, you're taking a lot less risk because in defensive private debt, you are generally senior and you're secured. And that means that you're at the very top of the capital structure with all the equity essentially sitting below us. And so we'll always be the first in line to get repaid if the company gets in trouble. And we have security over the assets of the company, compared to, say, bonds that are general unsecured obligations or compared to equity, which always takes the first loss. So the combination of that relatively low risk profile and, now the asset class yielding over 10% is, pretty attractive proposition for investors, particularly in this environment where the macro conditions are looking a bit shaky. And that's sort of been the key driver of the interest and the sort of increasing allocations to the asset class.
It's interesting. I guess that one of the kind of perhaps misconceptions about the asset class too is that you're giving money to a company perhaps that you haven't heard of before, or something that might be fairly obscure, a small perhaps enterprise that might have a high level of risk. But you say here that you can sort of effectively support the financing or invest in household names that perhaps, regular folk might be fairly familiar with.
Yeah, absolutely. That's right. I'll start with saying that the private debt universe is actually quite large, and it can essentially include anything from infrastructure debt, which has very low risk and return profile, and you go all the way up to your high risk bilateral SME loans, things like property construction and development, or even things like distressed debt and special situations, which are essentially equity like risk. But in the defensive side of the spectrum, what we call the core private debt market in Australia and New Zealand, we typically invest across three key sectors, and that's leveraged buyout loans, which is essentially funding private mergers and acquisitions in the domestic market. And that's personally, my area of focus and expertise. But we also finance ABS or asset-backed, securities, warehouse sort of private warehouse funding, and stabilized commercial real estate. But to bring it to life a little bit, when I say, that I focus on leveraged buyout loans, it might sound a bit exotic, but as you say, it is actually quite simple, and it is actually, funding some of the very well-known household names. Because in what we do, we provide loans to companies domestically, mainly to support private M&A activity in the market. And so a typical transaction would be a private equity firm buying a company, and we will provide the debt to finance that transaction. And so typically for every dollar of private equity, there is a dollar of private debt funding. And some of the examples of companies that we have in our portfolio and that we financed are companies like Arnott's Biscuits that everyone's very familiar with, things like MIOB accounting software, or HealthScope, which is the second largest private hospital provider after Ramsay, or Colonial First State, wealth platform. There's just to name a few examples. So you might be really surprised, but private debt is not necessarily a black box that some people might think it is. But we do actually finance some of the big household names that investors would be very familiar with. But the commonality is that they are not publicly listed, but rather private companies, typically in private equity ownership.
So what are some of the things that investors just need to be fairly conscious of at the moment when investing in the space? Because for me, I associate perhaps economic downturns with a higher default risk, and sometimes you can see spreads blow out as a result. At least that's perhaps in public markets. So the risk here fairly similar. What else do we need to be sort of wary of?
Yeah, that's a great question, and we get asked that a lot by our clients and prospective clients that are looking to perhaps make their first move into the asset class, or even just increase their exposure. It is absolutely crucial to be aware of what is in your portfolio, because as I said, the private debt asset class is really attractive with all the characteristics that it provides. But at the same time, the ability to deliver those target returns really relies on the manager's ability to avoid these defaults and loan impairments. And as you said, we are now entering an environment where default rates are on the rise. So investors really need to understand what they're investing in, understand the strategy, the manager, and the exposures that are inside those portfolios. There are a lot of areas of private debt that will come under pressure and that might struggle over the next 12 to 24 months. We've already seen property construction and development loans coming under a lot of pressure. You would be aware there's been a lot of headlines around, buildings falling over. And while we don't finance those type of loans at Revolution, a lot of that activity is actually financed in the market. So understanding and avoiding these types of exposures in the portfolio will be absolutely crucial as we enter, what I would call a more challenging economic backdrop. But even just anything that is discretionary in nature, really, we would expect to have period ahead. That includes things like retail, entertainment, hospitality, for example, things that are closely related to consumer spending. Because, just as the consumer will struggle, these are the top candidates that will see increased levels of defaults as well. More broadly, I'd also expect smaller businesses under further pressure, and that's simply just because of the ability to weather any storm. When you're smaller, your ability to deal with that sort of environment is a lot weaker. So bilateral lending to smaller companies or SMEs is also another area to watch. And the thing to remember is that this is an asset class that's illiquid, so managers can't just reposition their portfolios. Everyone will really get tested now for the loans that they made in the last few years. And it's particularly true in Australia and New Zealand, where the market is illiquid, even in good market conditions. And there's really no ability to trade out of loans as there might be in the US or European syndicated loan markets. Investors that are considering the allocations to private debt, they really need to do their due diligence and understand what is under the hood to make sure that they're not walking into a ticking time bomb. And
last but not least, and with that said, what areas of the market do you like right now? What could perform well in, I guess, the investment time frame that we're talking about here?
Yeah, look, I think anything that's not cyclical. At Revolution, we are naturally defensive and focused on innovations. So we favor sectors such as healthcare, medical software, professional or B2B services. These are sort of areas that are underpinned by stable demand and quite well in the period ahead. Secondly, just generally companies that can pass through the input cost pressures from higher inflation. So generally that's, larger companies and market leaders, because again, this type of should be able to pass through any inflation and input price increases over to the consumer or to their end market, and therefore maintain stability in their margins and earnings, which in turn then allows them to continue to service their loans. And so when you marry together, you'll get market leaders in non-discretionary sectors. That will be your best bet.